The year 2025 marked a significant shift in U.S. trade policy. With President Trump's return, tariffs became central to economic strategy, aimed at protecting American industries. However, the U.S. oil industry, a critical economic engine, finds itself vulnerable to these new trade barriers. The speed and breadth of the renewed tariff regime caught many off guard, prompting reassessments within the energy sector. The U.S. oil industry had experienced remarkable growth, fueled by technological advancements and significant investment. Shale oil production transformed the U.S. into a major global energy player, supporting millions of jobs and contributing substantially to the GDP. The prospect of new tariffs introduced uncertainty, with companies worrying about increased costs and potential retaliatory actions affecting exports. Tariffs on imported steel, essential for drilling and refinery operations, translate into higher expenses for oil producers, complicating the economic picture. The tariffs reintroduced by the Trump administration cover a range of imported goods, including steep duties on steel and aluminum. The stated purpose is to protect American manufacturers from unfair foreign competition and ensure national security. However, the reality for the U.S. oil industry is more complicated. The oil sector is a massive consumer of steel and other tariffed goods. U.S. steel producers may not meet the specific demands of the oil industry in a timely or cost-effective manner. Consequently, tariffs act as a direct tax on operations, increasing costs without creating viable domestic alternatives. Instead of fostering a domestic supply chain, tariffs can lead to project delays and increased expenses. Specialized steel alloys needed for high-pressure drilling might only be available internationally, making exploration more expensive. This financial burden can make some U.S. oil projects economically unviable. The assumption that tariffs will lead to a resurgence in domestic manufacturing is optimistic. Building new factories or retooling existing ones requires substantial investment and time. In the interim, oil companies face higher import costs and insufficient domestic supply. This situation can lead to a slowdown in drilling activity and deferred maintenance, creating operational hurdles and financial strain. The imposition of tariffs by the U.S. prompted swift retaliatory tariffs from major trading partners, including Canada, Mexico, the EU, and China. These countermeasures targeted U.S. exports, including oil and gas products. China, a major importer of U.S. crude oil and LNG, imposed its own duties, making American energy exports less competitive. This tit-for-tat escalation created significant uncertainty for U.S. energy exporters. Retaliatory tariffs make U.S. oil more expensive for foreign buyers, eroding profitability and potentially reducing export volumes. Trade disputes strain diplomatic relations with key allies and economic partners. Canada, deeply integrated with the U.S. energy market, faces friction due to tariffs on steel and aluminum. Such tensions can spill over into other areas of cooperation, including energy security and environmental policy. A contentious international trade environment makes long-term planning and investment in large-scale energy projects more challenging. Tariffs and trade wars introduce artificial distortions, potentially leading to regional price disparities and supply chain vulnerabilities. If U.S. LNG becomes too expensive for Asian buyers, they will seek alternative suppliers, harming U.S. exporters. This reconfiguration of global energy flows may reduce U.S. influence in global energy governance. The disruption to established trade patterns can lead to inefficiencies in global energy markets. Oil and gas prices are determined by complex supply and demand dynamics. Tariffs introduce distortions, potentially leading to regional price disparities. This harms U.S. exporters and can reconfigure global energy flows in ways that may not be advantageous to American strategic interests. The long-term impact on U.S. energy dominance could be significant. The most immediate impact of reimposed tariffs on U.S. oil producers is a significant increase in operational and capital expenditures. The oil and gas industry is capital-intensive, requiring vast amounts of specialized steel. Tariffs on imported steel push up prices, affecting every stage of oil production. Rising costs squeeze profit margins, especially for smaller independent producers. They may lack the financial cushion to weather such economic shocks, potentially leading to reduced drilling activity or insolvency. Retaliatory tariffs on U.S. oil exports make it harder to compete internationally. Buyers might turn to suppliers from regions not subject to these duties, shrinking the available market for U.S. oil. This is particularly problematic for the U.S. LNG export industry, which relies on long-term contracts and global market access. The cumulative effect of these pressures can lead to a slowdown in U.S. oil production growth. Companies will scale back investment in new drilling and infrastructure development. This affects not only oil companies but also service providers, equipment manufacturers, and workers. The dream of sustained American energy dominance faces a significant challenge. Domestic policies inadvertently increase production costs and limit access to international customers, creating a difficult operating environment. Steel is the backbone of the oil and gas industry. Tariffs specifically targeting steel imports have a large impact on production costs. A 25% tariff on imported steel raises prices, affecting project budgets. The construction of a new pipeline requires thousands of tons of high-strength steel pipes. Tariffs can add millions to the total cost, translating into higher transportation fees for oil producers. Higher steel prices make each new well more expensive to drill and complete. This reduces the economic viability of marginal wells and slows exploration activities. Certain specialized types of steel may have limited domestic production capacity. Ramping up such capacity takes years and significant investment, leaving oil producers with difficult choices. Tariffs create economic uncertainty, deterring investment in capital-intensive industries like oil and gas. Large-scale energy projects require substantial upfront capital and long payback periods. Investors need a stable policy environment to commit billions to exploration, drilling, and infrastructure development. The reimposition of tariffs introduces risk, making investors more cautious. This hesitation can slow the flow of capital into the U.S. oil sector, impacting long-term growth. Rising production costs due to tariffs diminish expected returns on investment. U.S. oil projects become less attractive compared to opportunities in other countries. Reduced investment can stifle innovation and the adoption of new technologies. A slowdown in exploration means fewer new oil reserves are discovered and developed. This can lead to a decline in U.S. oil production capacity. The oil and gas industry supports a vast ecosystem of related businesses. A chill in investment will lead to reduced business and potential job losses in these supporting sectors. One goal of recent U.S. administrations has been achieving energy independence. The shale revolution brought the U.S. close to this goal, transforming the nation into a net exporter of petroleum. However, tariffs on goods essential to oil production create a contradiction, working against energy self-sufficiency. By increasing the cost of domestic oil production, tariffs make American oil more expensive to extract and refine. If domestic production becomes less competitive, the U.S. might rely more on imported oil. Retaliatory tariffs on U.S. oil exports force producers to reduce output, countering the idea of energy dominance. True energy independence requires a thriving, cost-competitive domestic industry. Tariffs that raise production costs and invite retaliatory measures achieve the opposite. A holistic approach would consider the oil industry's entire value chain and its global interconnectedness.